Hi, my name is Carol from Provident Credit Union. Thank you for joining us today for today's webinar where we'll be discussing credit reporting and credit scoring basics. This webinar is being recorded. All attendees will receive a follow-up email with today's recording and a presentation deck within a week. All participants have been muted, so please use the Q&A box for any questions and we will answer them at the end. Your presenter today is Rod Griffin. He is the Senior Director of Consumer Education and Advocacy. And with that, I'd like to now hand it off to Rod. Welcome, Rod.
Great. Thank you so much. And I'm glad to be here today and hope to share some helpful information. I'll start with, I guess, a little bit of additional introduction. I've been with Experian for 28 years. And so I've heard and talked to and answered just about every question I think that could come along. And in this presentation, I want to share some fundamentals, some basic things to lay some groundwork around credit reports and credit scores, and then I hope go as deeply as we need to in the conversation and answer questions. So I'll move pretty quickly because there's a lot of ground to cover, but want to make sure we have time for questions at the end. So if you go to the next slide, please. Just as a title page, this is going to be about credit reports and credit scores and why they matter. I always start with this concept. Credit is not a right that you have, it's a privilege that you earn. And you earn it by making good choices and good decisions around your credit usage. If you use credit well, it can be a financial advantage. If you use it poorly, it can get you into debt and be a financial burden. And we really want you to use credit well, to use it in ways that give you a financial or more financial opportunity and help you be more successful and more financially healthy and not make mistakes that so many of us do that get us into trouble. Next slide, please.
Oops, I jumped too soon. Let me go back.
So again, just at the very basic level, so to start the conversation, we need to define what credit is, and it's simply obtaining goods or services and paying for them at a later date under agreed upon terms that are in a contract. Today, it includes the things that we often think of, credit cards, mortgages, car loans, and so on. But it may also today include other things that aren't as traditional. It could be things like cable television service or streaming services. It could be cell phone payments each month. Could be utility payments for things like natural gas or water, electricity. Could be your rent payments. Could even be insurance payments today that affect credit histories and credit scores. And in all, they represent your financial references in the form of a credit report, which I'll go into a bit more detail in just a few minutes. Next slide, please. Another important concept and idea is that credit and debt aren't the same thing. They're often equated, but they're actually two different things that are just very closely related. You can have credit and not carry debt. For example, if you have a credit card and it gives you cash back on purchases or airline miles, you make all of those purchases that you make in a month with it and get those airline miles or that cash back, the savings, and then pay the balance in full right away. You don't carry any debt. You don't have to pay interest, but you have a financial gain as a result. That's the way we want people to think about credit, to use it to build a positive credit history so that you can get the best terms when you need it. In a sense, invest in debt in some cases. So if you think about buying a house, you're really investing in debt, a mortgage that will, in most cases, gain in value over time and be a positive investment. So think about credit as a financial tool. Debt's the financial problem. Next slide, please. So that leads to where that information lives. Where does that credit information reside? And that's with the three national credit reporting companies in the U.S., Experian, Equifax, and TransUnion. Most people, unfortunately, when they first come in contact with the credit bureaus, is often a result of a problem they've had. They've had an application declined. They've been a victim of fraud, things like that. And so they come to the credit bureau with a difficult situation. The reality, though, is that in most instances, in financial transactions, a credit report is used in the background. You qualify for what you've applied for. You get the financial services you need, and it's almost seamless or invisible. And that's what we really want to have happen. We want your credit history to be there to work for you. And because we have a national credit reporting system, we are able to have benefits in the US that many countries and residents and citizens of other countries don't have. In the past, if you lived in New York City and you moved to Los Angeles, you lost your access to credit because credit was based on personal relationships with the merchants in your community. Today, that's no longer the case. We have a national automated computerized credit reporting system, and as a result, we're able to provide services like instant credit when you apply online or in person. You can buy a car in a matter of an afternoon in many cases. We make credit lower cost than anywhere else in the world because we're able to help lenders manage risk more effectively and to reduce their losses so they can pass those savings on to the consumer public. We make credit available nationwide. As I said, if you move from one part of the country to another, your credit history goes with you. We make credit available in a widespread manner, meaning you can use it for almost anything. If you make that move from New York to Los Angeles, you can rent an apartment. They'll check your credit report when you apply for that lease. You can then furnish that apartment. You could buy a car. The credit history might even help you get the job that you moved for. And so it's important that it be there for you to use to your advantage. And perhaps most important and least thought of is your credit history can be a personal account management tool. You should check your credit report, just like you check your bank statement each month or your credit card billing statement to know what's there. Make sure that everything's being reported accurately, correctly, completely, and that there are no signs of fraud or identity theft, things you might need to take action on. We want you to be engaged in that process and make sure that it's there to work for you when you need it. Next slide, please. So, all of that said, why are credit reports important? And really, what are they? Well, your credit report simply is a record of your financial obligations and accounts and the identifying information that is associated with them. About 220 million consumers, actually more than that today, with credit history. So we need to know your identifying information as well as the account information that goes with them. We call it a credit file, a credit report, a credit history. They're all essentially the same thing, just different terms to describe that credit report or credit history or credit file, but they refer to the same thing. We use credit reports, or lenders do, and credit scores to gauge the likelihood that you'll repay a loan as agreed or that you'll not default on a loan. So what is the risk of making a loan to you? A strong credit history is going to enable you to obtain a credit card or perhaps more than one credit card, perhaps buy a house, get a car, and other valuable credit services and financial resources. Again, things like if you're applying for a cell phone account, want to get that new phone when it comes out, they're going to look at your credit history. If you're leasing an apartment, they'll review your credit history. When you buy that new car, the insurance company is going to look at your credit history to help determine that you can pay their premium each month on time. It's a financial decision. So your credit history is very important and not just about traditional credit relationships today. It again is your financial reference, or really a list of your financial references that businesses will use to help them determine if they want to work with you. And just like your resume, you want those references to be positive. You want them to say good things about you so you can get the credit you want and need when you want and need it. Next slide, please. So that leads to, okay, there's this credit history, credit file. Where did it come from and how do I begin one? How do I get a credit history? Well, I often have parents who've had a new baby say, hey, I just got my new baby's social security number. Can I get their credit report too? And I tell them, I hope not, because that means your new baby is already a victim of identity theft. We don't want that to be the case. For most people, you don't have a credit history until you apply for credit and have an account opened in your name for the first time. Generally, that's when a person's in their late teens, early 20s, when they first begin to use credit and engage in the financial system. It's really pretty simple and straightforward. When you apply for credit, the lender says, we'll take a chance on you. We'll open an account for you. At the end of that first billing cycle, you pay the lender, and they then update their records and report that account to Experian, at which point we create a credit file for you. In the future, after you've made some payments, you may apply for a new account. That new lender is going to look at that credit report and say, oh, good, you've paid the first lender well, you're reliable, we'll open an account for you also. You'll pay them at the end of the first billing cycle. They'll update their records and then report that account to Experian. Now 2 accounts appear on your report. And over time, that credit history will build and that cycle will continue. Next slide, please. So now that we have that credit file, the next question that I often hear is, well, what is your role as a credit bureau? And there are a lot of misunderstandings. I hear from people that think we do all sorts of things that we don't as a credit reporting company. People will tell me, well, you approve or decline my application. We don't. The credit bureau doesn't do that. The credit bureau decides whether or not you have good credit. In fact, we don't. We don't make judgments about the information in the credit report. Our responsibility is to accurately reflect what lenders tell us is in their records so that you can see that and others can as well. And we have a dispute process that I'll describe if you find something that you believe isn't accurate. But the credit bureau doesn't make any judgments about the information in the credit report. We don't decide whether a person has good or bad credit. We don't score credit reports, which is a common misperception. We can be involved in the scoring process, and I'll explain how that works in a bit. But we don't score the reports. We don't decide if a person's approved or declined. All of those things are determined by the lender. They use your credit history, your credit report, to help them make those decisions. So we provide information, kind of like a library has books that they can then use to make those decisions. So we collect and store information, kind of like a library collects and stores books, in a format that the lender can check out and then use in those decisions. Kind of like the library, if you have a library card, can check a book out to you and you can read it, and then in the case of a library, typically return the book. But the business would check out a credit report for that one-time use. They also have a library card. We call them permissible purposes under the federal law. And they have to have that library card, that permissible purpose, to get a copy of your credit report. Next slide, please. So here's a question for everybody to who's on, if you would like to take a guess at what the answer is. Which of the following is not a permissible purpose for accessing a person's credit report? Is it getting an pre-approved offer of credit? Is it underwriting insurance? Is it test driving a new car? Or is it eligibility for a government license? Which of the following is not a permissible purpose for your credit report to be requested or accessed? We'll give just a few seconds to answer. 60% of you said to test drive a new car, underwriting insurance, and eligibility for government license for the other two. The answer is test driving a new car. You can go to the Ferrari dealership and tell them, hey, I'd like to test drive that Ferrari. And if they say, great, let me get the keys, you can drive it around town. When you pull back into the dealership, say, thank you very much, and walk away. And they have no reason at all or no permissible purpose to check your credit report. However, if you're driving around in the Ferrari and you say, how much does this car cost? They now have a permissible purpose because you've initiated a financial discussion. So you've expressed an interest perhaps in buying that car. And so now they can check the credit report. You have to have that financial discussion. Next slide, please. So these are the permissible purposes under the federal law, under the Fair Credit Reporting Act. So these are the reasons a business might get your report. One, to open or manage credit accounts. That kind of makes sense. To make pre-approved offers of credit, or what we call pre-screened offers of credit. In those instances, no human being actually looks at a credit report. This is the first thing to understand. It's an automated process. A lender will send us a request that has the criteria for making the offer, and they'll tell us we need 100,000 addresses for people who meet these criteria. And we run it across our database electronically, and then we send a mailing list to the lender, who then sends it out by snail mail, perhaps on paper, or through email. and then you can then respond. So they have a permissible purpose to do a pre-screened offer. You can opt out of getting a pre-approved offer of the pre-approved offers provided or created by the credit reporting companies. They go to call 1-888-567-8688, 1-888-5 opt out, or you can go to, I believe it's optoutprescreen.com, but check me on that. So it might be pre-screen opt-out. I flip them around all the time, but you can opt out of getting those if you'd like to. For employment purposes, in most states, some are now prohibiting that. But for employment purposes, you must give, or pardon me, for employment purposes, you can in every state, you must give written permission first. It's the only instance where express written permission is required before your credit report can be accessed. So for employment, it's also important to understand that employers never get credit scores. So credit scores do not prevent you from getting a job. That's a very common myth. Employers get a limited version of a credit report that is screened for any information that would violate Equal Employment Opportunity Act regulations, for example. So we remove any of that information. So it's identifying information and account information. There's no account numbers, things like that. So it's a limited version of a credit report. Underwriting insurance has been part of the law since it was enacted in the early 1970s. Some states now prohibit use for underwriting insurance. Most still allow it. And what insurance companies are looking for when they get your credit report is the likelihood that you'll pay the premium each month as agreed, kind of like a loan payment. So it's a financial decision. They're not predicting that you'll wreck your car. They're trying to determine if you can make the premium payment. They also are looking at the report, and they have insurance scores that are different than what lenders use. And so they're predicting the ability to pay that premium, and also in some cases to predict the likelihood you'll make a financial claim. They're not predicting you'll wreck your car, but will you make a financial claim? So that's what they're using them for, as a financial tool. A business transaction initiated by the consumer means you've applied, or in the case of the Ferrari, said, hey, I want to know how much it costs. I might be interested in buying it. You've initiated that transaction, and they can check your credit report. A court order or federal grand jury subpoena, of course, we're going to provide a credit report for evaluation of risk of an investor, meaning if there's a startup that you say, hey, I'd like to invest $1 million in your startup, they could check your credit report and say, no, but you have $3 million in debt you probably need to pay first. Eligibility for certain government licenses, things like security clearances in particular, are very important. And disclosure to you as a consumer. You can get your own credit report as often as you like. It doesn't affect credit scores in any way. It doesn't affect lending decisions in any way, to check your own personal credit report. Next slide, please. So we've talked about where credit reports come from, how they come into existence, and permissible purposes for getting them. So who are those players in that process? Who uses them, and how do they engage? And of course, credit reporting companies are at the top of the circle for me, because that's who I work for. I work for Experian, so we start with them. We collect and store the information about how a person is managing their credit. Lenders use credit reports to help them manage risk decisions and to determine the risk of doing business with you. Risk score modelers are often known by name but not understood. They're often equated with the credit bureaus, and they're not. The risk score modelers are the ones who actually create the risk score algorithms, and the scoring models is what we call them. And people, again, know their names. They're FICO, for example, Vantage Score, two of the best known. There was some news today, in fact, that Fannie Mae and Freddie Mac, the government agencies government entities that manage secondary mortgage market, have said that Vantage Score can now be used, 4.0 to be specific, can be used in mortgage lending. So there's new competition in the mortgage market among the scoring developers, but FICO and Vantage Score are two of the best known. They create the algorithms and the credit scores. Those algorithms are proprietary to them. The credit bureaus don't know what those algorithms are. They belong to FICO and VantageScore. That's why we call them. What I always say is that's why FICO scores are called FICO scores. They are FICO's scores. And Vantage scores are Vantage scores, and their algorithms. The government, of course, we're very heavily regulated at the federal level as well as the state level. And in one instance, there was a county ordinance that also in California that governed credit reporting. And it's everything in the law from who can access a credit report and under what circumstances, what information can be in a credit report for how long, to if a credit report is printed on paper, what font must be used and what that type size needs to be. So we're very heavily regulated, and that gives you great oversight and transparency to what we do. And of course, you as the consumer are at the center of that process. You decide what credit you're going to use, when you're going to apply, how much you're going to borrow, how much you're going to spend, how you're going to repay those debts. So you can control the information in that credit report, and you can see what information's in that credit report at any time you'd like. Next slide, please. The other key element for you as a consumer and being at the center of that process is that the first information in your credit report comes from you. You decide when you're going to apply, and when you apply, you complete the application. The application information is the first thing that comes to Experian and the other credit bureaus. So we strongly recommend that when you apply, that you be very consistent in how you apply. So use the same name, for example, maybe use your full given name or on your birth certificate, or if you use a nickname or a shortened name. So if your name's Robert and you use Bob, be consistent in using Bob. That's going to help us make sure that the information in your credit report is accurate and complete, because we're going to have consistent identifying information that will ensure we match accounts fully and completely. So that consistency can be very helpful. Next slide, please. So finally, we get to what's in a credit report, and the kind of the important stuff about what's going to drive lending decisions. And it's really simple, very straightforward. In a credit report, the best way to think of it is, if it's debt related, it can be in a credit report. If it's not debt related, it won't be. But you're identifying information, your accounts. So we need to know who you are. As I said, there are more than 220 million credit active consumers with credit reports. And in almost every instance, you are not the only person with your name. There are other Rod Griffins out there, from experience. And one of them wasn't so good with his money and his credit. And I had difficulty renting an apartment when I first moved to Dallas because they confused the two of us, and I had to prove to them I wasn't that other person, that other Rod. So we need to know your name, your address, your social security number, your date of birth, your previous addresses, your any variations in your social security number will be shown in your credit report. Any variations in your name, as well as any variations in your address. When you hear about errors in a credit report and see those reports, when you look at the most sort of well-known ones, they talk about the number of errors in a report, and you look at the fine print, and it says 85% of the errors that were identified were variations in name, address, or social security number. The reality is those are not errors. We include them on purpose so that you can see them, because you might apply, as I said, if your name's Robert, you might apply for one loan as Robert, you might apply as another as Bob. And so both of those names would appear in your credit report. Both would be correct because they would show what's in lenders' records. We don't have direct access to Social Security Administration information. And so we list all of them that might be reported. In most cases, people see one. But if you have 10 accounts, you might see 9 of them that would list the same social, and then one's different. Usually when we see that, it's a transposed digit. So instead of 1, 2, 3, 4, 1, 3, 2, 4 gets entered, and we can help you identify where that came from and get it corrected. But if a variation in name, in an address, or in a social security number are the result of fraud, we want to make sure that you can see them so you can act on them. So it's a really important thing to understand that when you see variations in name, address, social security number, they're there purposely. They're not errors. They're there so that you have that information. They don't affect credit scores in any way. So it's important to understand that as well. The heart of the credit report is account information, what types of account you have, so it could be a revolving account, an installment loan, a mortgage loan, and so on. Your association with those accounts, whether you're the primary account holder, a joint account holder, authorized user, so on. And then you would see the principal balance on an installment loan, so how much you borrowed originally, or you might see the credit limit on a revolving account, which is a credit card. And then you would see the remaining balance if it's an installment loan. You might see the current balance, or would see the current balance for your credit card. And those two things are really critical. You would then see the payment history for that particular account. That is by far the most important thing in the credit report. Are you paying your debts on time, or are they late? If they're late, how late are they? When it comes to a revolving account, a credit card, that balance as compared to the limit is going to be the second most important factor in credit scores, which we'll talk about in a bit, because the higher the balance as compared to the limit, the more risk it represents. So you'll see that information. You'll also see the status of the account. Is it current? Is it late? If it's late, how late is it? Is it 30 days late, 60 days late, 90 days late, so on? An account is considered late at the credit bureaus when you've missed a full billing cycle, so 30 days. So if your due date is today and you don't get it paid until tomorrow, you won't see that in your credit history if you make that payment the next day. You might still see a late fee or an increase in your interest rates, those sorts of things, but it wouldn't be reported to the credit bureaus. You have to miss a full billing cycle. And then you would see the status as well, if it's paid in full, if it's closed, if it's open, if it's been charged off as a loss. And if it's been charged off, you might see transferred or sold to collections, and then the collection account that goes with it, and often transferred from or acquired from, so you can track the history of that debt from start to end. Bankruptcy public records today are the only public records that appear in a credit report. Really important to know. Bankruptcies, of course, are debt related. And so they're going to be in the credit history. There are typically two types, Chapter 13 and Chapter 7. Most people, those are the two you'll see most commonly. And they are the only ones left. We used to have things like civil judgments. If you were sued and you lost, you had a debt to the court. We had tax liens, whether they were paid or unpaid, they would appear in the credit report. When I started with Experian, we still had library fines being reported to the credit bureaus. We no longer do that. We had parking tickets that were reported. Oddly, San Diego was somewhat notorious for reporting parking tickets. Those are no longer part of a credit report. So the only thing you'll see in a credit report today are bankruptcy public records, generally Chapter 7 or Chapter 13. You'll also see a list of inquiries in a credit report. Inquiry simply is a record of who's requested that report. You may see two types. You would see what we often call a hard inquiry, which is an inquiry that results from your application for credit. And because there's potentially a new debt that is associated with it, but it doesn't yet show as an account, that inquiry indicates some risk, and so it can be shared with lenders and may affect credit scores a little bit. It's the least important factor in credit scores by far. There are also what we call soft inquiries, which you may see more of. You typically don't see very many hard inquiries. Soft inquiries include things like pre-approved credit offers, inquiries for insurance purposes, inquiries for employment purposes, requesting your own report. And so you may see a number of those, and they are shared only with you in credit history, so they don't affect credit scores at all with a true soft inquiry. And so you don't have to worry about those. They're there as a record for you. There is a third inquiry today that is beginning to appear that sits kind of in between the two. I'm not sure if you've all heard of, I suspect you have Buy Now, Pay Later, or BNPL. We are just beginning to report Buy Now, Pay Later loans because they are short-term loans, typically pay in full within a month. The industry is trying to figure out how to work with them. And so currently we are collecting Buy Now, Pay Later loans information from a firm at Experian. We're one of the first of the bureaus to do so. We are not sharing that information with lenders at this time. So you would only see it on your credit report, and we are not including it in score calculations, or feeding it in so that it can be included in score calculations would be more accurate. But at some point, when we reach a critical mass and have enough information reported and are confident that it's being working as it should, we will begin to share that information with creditors. Inquiries at this time kind of fall in between soft and hard. The buy now, pay later inquiries may be shared with lenders, but they will not be included in score calculations. So there would be a record of the buy now, pay later inquiry, but it would not affect credit scores. So they fit in between the hard and soft. So we're early in that process at this point in that system. And so those are the really now kind of three types of inquiries you might see. And dispute instructions are also included. How do you contact us if you find something you believe is incorrect or might be the result of fraud? You'll see a toll-free telephone number, a web address, and a mailing address as well. So before we jump further in, I want to talk about a couple of other things that are really creating new opportunities for individuals and for all of you in the credit reporting world to help improve your credit history. You may have heard of Experian Boost. It's been around since 2019. When it first was launched, let me explain what Boost is. Boost is a free permission-based service that lets you have only positive payment information reported for accounts that haven't traditionally been reported to the credit bureaus, but are very credit-like. So you could have your positive utility payments reported, so things like natural gas, water, electricity, your streaming services like Netflix or Hulu or HBO Max, your telecom payments for things like your cell phone bills could be reported to Experian. And the way that worked and still works is that you would enroll in Experian Boost at experian.com/boost and give us permission to capture the information from the bank account or credit card that you use to pay those bills each month. And for each of them you tell us you wanted to add, we would add an account. So if you said, I want to add my gas bill, my cell phone bill, and my Netflix bill, you would have 3 new accounts showing those positive payments each month on your credit history. We've since added rent payments. We work with about 1,500 leasing and property management companies, and that number is growing, as well as some online rent reporting organizations. And we now have included insurance payments as well. So if you're making your auto insurance payments on time, you can benefit from that by enrolling in Experian Boost. Again, it's free and it's permission-based. So you give us permission. If you change your mind, we'll stop. You can tell us you don't want to do it anymore. What we're seeing is that when people enroll in Boost, if they have particularly lower credit scores, 680 or below on a FICO 8 scale, they see the most benefit, because it's really about helping to improve credit histories for people with thin files, fewer than 5 accounts, or have had some issues in their recovering. And so we see those people benefit the most. On average, we see an increase of about 13 points on credit scores when people enroll in Boost. For people with those thin files or lower credit scores, that average is closer to 19 points. So it can be a really powerful way to get moving in the right direction if you're new to credit, or to help rebuild if you've had some issues and you're moving in the right direction again. Next slide, please. And we know it's important because of these issues. We know there are about 28 million credit invisible consumers. We know that more than a quarter of the Black and Hispanic population are unscorable or credit invisible. We know that 4 million consumers turn 18 every year. And we know there are about 20 million consumers between 18 and 23 who have very little or no credit history. We also know that we get 30,000 telephone calls from people each month saying, hey, we want to establish our credit history if we can. We know there's a need for that. And it's really about helping people overcome those barriers to access, because without a credit history, it's very difficult to build a positive, strong financial life. And so having a credit history is the first step in that process. Next slide, please. And along the same lines, we recently introduced in the last year and a half something we call Experian Go, and it's part of our app, our free app. So if you enroll in Experian's free app and you do not have a credit history with us, we can help create one for you. Next slide, please. Again, it's really easy. When you enroll in the app, you open the app. We're going to ask you some questions to identify you. So, government issued ID, a selfie, a live selfie, so you can smile or wink, and we will create what is essentially a blank credit report with just your identifying information. At that point, you could enroll in Experian Boost and have those added, or take steps to become an authorized user, or we have a credit card offerings, or maybe you work with Provident to help open a secured account that would then be reported to that credit history. The key is a credit history then exists for you so you can use it to your advantage. And that takes about 10 or 15 minutes. We've seen people move from having no credit history at all to having a FICO score in the low 600s, 620, 630, in a matter of 15 or 20 minutes. So you're not going to have a great score, but it's going to help you move in the right direction and become visible so you can work on building that credit history. Next slide, please. Just quickly, I want to talk about initiating disputes, because I want to try to leave some time if I don't talk too much. When you get your report, you'll have information to contact us. You can dispute online, by telephone, or by mail. The thing that's most important here is probably the last bullet. The dispute needs to be specific. Make sure you tell us which account it is and what the issue is. So this account is not mine. This account was never late. This account is fraudulent. We'll be able to help you much more effectively. If you dispute online, we kind of walk you through that to make sure we have the information we need to be able to communicate effectively with the source of the information and have the issue addressed. Next slide, please. In processing a dispute, what the law says is we're allowed 30 to 45 days to process. In most cases, we complete disputes in 10 to 14 business days, quite often now 2 to 3 business days, because we're able to do things electronically. Once in a while, we have an instance where we have mail that needs to be sent, and so that 30 to 45 days may apply, but that's extremely rare these days. But give it some time. You won't see the results right away. When that dispute is completed, we'll notify you of the results. Those results will say either the account needs to be updated in some way. So it may not be exactly how you disputed it, but you'll get an explanation. The account should be removed, or it should remain as reported. And at that point, you can add what we call a statement of dispute. Again, in this slide, the last bullet may be the most important. If you disagree with the results of a dispute, you can add what we call a statement of dispute to your credit history. It says, I disagree with the results. Here's why, and lets you tell your side of the story. Anytime your report's requested, the requester will be notified that that dispute is on the file and that they should look at it, and can help them. Then if it's an automated system, maybe kick it out into a manual review, which might slow things down a bit, but you would still be able to have that statement reviewed and can help explain what the issue is as you see it, to let you tell both sides of that story. Next slide, please. So how long does information remain in a report? So we talked about what reports are, what's in them, how long does it stay? And again, I hear lots of things, really pretty straightforward. Open accounts in good standing can remain indefinitely. I've seen credit cards that have been on reports for 30 years are open and active and still being used. Closed accounts in good standing, meaning there's no late payments or other delinquencies or derogatory information, remain for 10 years from the closed date. So the good stuff stays longer than the bad stuff. So you don't lose the history of an account when you close it. So that's important to understand. I often hear that's not the issue. If you close an account, it stays on the report if it's in good standing for 10 years. Late payments, missed payments remain 7 years from the date of the missed payment, called the delinquency date. It gets a bit more confusing with collection accounts. Collection accounts remain for 7 years from what we call the original delinquency date. The original delinquency date is the date the original account first became late and after which was never again current. So if you miss a payment today and you never catch up, the account's charged off as a loss. It's sold to collections. 7 years from today, roughly, the original debt account and the collection will be deleted at the same time. The collection account is treated as a continuation of the original debt. They cannot change that date. Collection agencies are required by law to report that date, when they report information cannot be changed. You can work with a collection agency, pay them, negotiate with them. That date won't change. To make it a little bit more confusing, if you had a late payment today, you caught up next month and it was reported as current, and then you fell behind again the next month and were never again current, 7 years from today, that first late payment would fall off because it's a late payment. A month would pass because the account was current, and then it and the subsequent collection would be deleted. So it's the original delinquency date is a date the account first became late and after which was never again current. So that can be a bit confusing. Chapter 7 bankruptcy remains for 10 years from the filing date because you do not repay any of the debt. Chapter 13 bankruptcy remains for 7 years from the filing date because you do repay some of the debt, so you get a bit of a break. Inquiries remain for 2 years as a matter of law. That's how long they need to stay. They don't affect credit scores typically for more than 2 or 3 months because there'll either be a new account and that becomes the risk indicator, or there is no new account, you didn't open it, and so the inquiry doesn't represent any risk. And so it really doesn't affect scores anymore. And in most cases, inquiries have a 5 to 10 point impact on scores, and again, for a very short period of time. Next slide, please. So another poll really quickly. Which of the following is not a credit myth? A, when paid, the bad debt will go away. B, you can have a 900 credit score. C, you have to give permission for the report to be issued. Or D, the credit bureaus are responsible for choosing who gets credit. Which of those is not a myth? Just a few more seconds. And consumers must give their permission for a report to be issued, and the credit bureaus are responsible for choosing who gets credit, were the two answers. Both of those are incorrect. So the one that is not a myth is B. You can have a 900 credit scores. You do not have to give permission for a report to be issued, except for employment. So it's a little bit of a trick question. And the credit bureaus don't decide who gets credit. But you can have a 900 credit score. So insider information, FICO scores for auto lending, for car lending, actually go to 900. So you could have a score higher than 850. Most people don't know that. Next slide, please. So that gets us to credit scores, which most people want to talk about. The reason I cover credit reports in great detail first is because credit reports are what are really important. You can take care of your credit report. You can change that credit report. Credit scores just reflect the information in that credit history, in that credit report. So if you take care of your credit report, all of your scores will get better. But it's important to understand that first. A credit score is simply a tool that's used to analyze the information in a credit report. There are literally hundreds of different credit scores and scoring, what we call models or formulas, with different scales from different sources. So Vantage Score and FICO, for example. FICO, there are more than 60 different FICO scores. Vantage Score is on Vantage Score 4.0 now. So there were scores before that. Lenders have their own custom scores. I've seen scales that range from 350 to 850, which are the most common. FICO scales that go from 350 to 900 if you're buying a car. Vantage scores that went to 920, I want to say, 950, that they no longer use that scale. Saw a score that went from 75 to 108 once. So don't know why they chose that scale. So there are different scores, different scales for different types of lenders and different types of lending. So if you're buying a car, they have a different score than if you're buying a house or getting a credit card, because they're analyzing the information in your credit report differently to determine risk for that particular type of loan or credit agreement. If you are Provident, a credit union, they may use a different score than a national bank, because the customers that they work with have different kinds of credit histories and different kinds of behaviors as a whole, and so their scores reflect that. That's why there are so many different scores, but you only have 3 credit reports. A credit reporting company, let me get that last one's really important. Credit reporting companies might what we call apply a credit score. There are about 240 different scores that reside in our system. So FICO actually effectively rents space from us in our databases. And when someone asks for Rod Griffin's credit report, Experian compiles that report, and they can say, I want the FICO 8 score applied. And so we route the report through the keyhole into that space that FICO's renting from us. A credit score is calculated, and the credit reported score go out the window on the other side to the lender, and the lender can say, I want the identifying information on the report to show on my screen first, and then the credit scores, and then the rest of the credit report. And it looks like the score is part of the report when in fact it's not. They're two different things that go out in parallel. So that's one way scores happen. Credit scores might also be calculated after the report is sent to the lender, so the credit bureau doesn't have any role in it at all. If you're in mortgage lending, we send the reports to a third-party mortgage reporting company, and they get other credit reports, they get application information, other information, and they apply credit scores, and then they send all of that to the lender. So the credit bureau might have a role in credit scores, but often don't have any role at all. And it's important to understand that the formula, the algorithm called the model, is proprietary to the score developer. So FICO scores are FICO's scores, and they're proprietary to them. We can help you with what's in that credit history. Next slide, please. Excuse me. And so all of that said, what do you do with a number then? How do you know how to make it better? And the answer is pretty straightforward. What people don't know is that every time a credit score is calculated, a series of risk factors are generated. Those risk factors tell you what from your personal credit report most affected the score you received. So they tell you exactly what you need to work on in your credit report to make that score better. The scores can be very different because scales can be different, and there are different lenders, different types of lending. The risk factors, though, are very consistent from one score to another. So if you address the risk factors, you make your credit history better, all of your scores will get better. So I was kind of tongue-in-cheek say the scores don't matter. The number doesn't matter. And it doesn't in a situation like this. What matters is your credit history. If you take care of the credit history, that score will get better. Of course, scores matter when you're sitting with your lender applying for a loan. But if you're working on making your credit history stronger, your scores will get better, and you'll be ready when you walk into that lender and know that you'll have a good score. Next slide, please. One more poll. Which of the following is not a credit score risk factor? Credit utilization, the balance of your checking account, your payment history, or how long you've used credit, which is not credit score risk factor. Just a few seconds. We'll go fairly quickly. I've talked too much as usual, and I want to get to the questions. And everybody knows what they're talking about here. The answer is B, the balance of your checking account. We do not have asset information, so we don't have things about checking accounts or savings accounts or CDs or IRAs or 401ks. Lenders are looking at a credit report to help them predict the likelihood you'll repay a debt, or what we call your propensity to repay a debt. They look at your financial documents, your checking accounts, savings accounts, check stubs, those sorts of things to determine your ability to repay a debt. The reality is that just because a person might have $1 million in cash doesn't necessarily mean they'll use that $1 million in cash to pay their debts. And so they're looking at, on one side, your ability to repay, and on the other, your tendency or your propensity to repay. So it gives them both sides of that picture. Next slide, please. So when you look at a credit report, I won't spend a whole lot of time here. You'll see similar charts for other scores. This is from Vantage Score 3.0. The key takeaways here are pretty straightforward. Payment history is always the most important factor in credit scores. You have to pay your bills on time every single time to have good credit scores. Late payments will wreck credit scores and do so very quickly. Utilization, your balance on your credit cards, what we call your balance to limit ratio, is the second most important factor in credit scores. In this chart, Vantage Score is interesting because they break out utilization and in total. So add up all of your credit card balances and all of your credit limits and divide, you get a total utilization rate, and that's about 20%. Balances on individual accounts or utilization on individual accounts is another roughly 11%. So that's 30%, 31%. So in total, payment history and utilization is about 70% of a credit score for Vantage score. It's very similar for FICO, 60 to 70%. To pay your bills on time, keep your balances low on your credit cards, pay them in full if you can. You do not have to carry a balance to have good credit scores. If you carry a balance, if you leave some balance, you're just going to pay interest on that balance. The rest of the things that go into a credit report happen organically with time. Your depth of credit, how long have you used credit, the mix of credit accounts you have will grow over time. That's about 20%. What you do recently, have you applied for new credit? Have you paid off a debt? Have you taken on more debt? All of those sorts of things go into that recent credit, those inquiries. It's about 5%, and then 3% is your overall capacity, sort of the round out the 100. And you'll see very similar charts for FICO as well. But bottom line is there's no big secret to scores. You have to pay your bills on time every single time. You have to keep your balances low as possible. Pay them in full if you can on your credit cards. Everything else will kind of build on those two things. Next slide, please. There's no silver bullet. You can't fix credit overnight. If the information is accurate in your credit report, and most of the time it is, you're not going to be able to make it perfect the next day. Your time is critical, and how you use credit over time. Address those risk factors, your scores will get better. Next slide, please. Just a few resources we have available. If you go to Experian.com, you can get free credit reports, free credit scores, free credit monitoring, and other information. We have marketplaces for credit cards and for insurance. If you're shopping for auto insurance, might save some money there. We're on average about $800 a year, they tell me. So use those resources. We have great educational resources that are free there as well. Next slide, please. And if you want to get a free report at annualcreditreport.com, that's the federally mandated report. It says the law says one free credit report every 12 months, once a year. By policy, the credit bureaus will provide you one free credit report once a week. So you can get 3 free reports a week, one from each bureau. That's 156 a year. Don't think you need to look at it that often, but if you want to, you can. So you get a free credit report. There's typically a fee for a credit score through annualcreditreport.com, just so you're aware. Next slide, please. And again, we have a number of education resources. You can join us every Wednesday at Experian, 2 o'clock Central, 3 o'clock Eastern on X. We started a chat in 2012. We still have great chats. Just had another great one yesterday on a mid-year financial checkup and why that's so important. So join us there if you'd like, ex.pn/credit chat. You can learn more. And if you go to Experian.com/consumer education, you'll find lots of resources. And with that, I'll stop talking and try to answer the questions you have. And I see there's a couple in the Q&A.
Yeah.
So I can just jump right to them. Are services like Experian Boost only available at Experian? What happens with lenders not using Experian? So Experian Boost is specific to Experian. The majority of lenders use all three today. There are some small local or regional ones who don't. The data will only appear, Experian Boost only appears, those accounts, in your Experian report. That said, people say, well, then why do it if it's not on all three reports? Well, the bottom line is, if you're establishing a credit history with Experian, Boost will, and our data shows that it helps people then qualify for more traditional accounts. So you may be able to then qualify for, say, a starter credit card, for example, or start an account with a lender, a credit card account or a small loan. That loan will then be reported all three. So it's a tool that helps people, particularly who have been credit invisible or who have very little credit history, begin to build that history so that they can in the future, and typically not too distant future, fairly soon, be able to qualify for accounts that would then be reported all three. So people ask me, well, if it's and Boost also isn't reported into current mortgage scores, so FICO 2, because it reacts incorrectly because it's so old, it doesn't know how to use that information, so we don't include it, don't let it feed into that when the mortgage lenders want to use it. And so the and it's not really there to get you across the finish line, I guess, is what I'm trying to say. It gets you in the race and helps you run that race so you can win it in the long term. So it's about getting started and getting on the right foot. Um, and there are some changes as of today in the mortgage world as well. If you've seen the news, they now Fannie Mae and Freddie Mac have said they will accept Vantage Score 4.0 and as well as FICO, so that may change some things there in the near future. So hope that helps. It's a great way, a great tool to help build credit if you haven't had credit, so you can be successful in the future. If you settle a debt, whether in installments or lump sum to a credit card company, how does it impact your credit, and how long does it take to rebuild? How long does it remain? So if you settle a debt, you negotiate repayment at either for a lower amount than you originally borrowed or lower interest rates, other terms. It will be reported in your credit report as settled or settled paid for less than agreed. That settled account will remain for 7 years from the original delinquency date. If it's in collections or from the charge off, will be there for 7 years from the settled date, and it will be very negative for credit scores, and will typically take potentially a number of years for your scores to recover. It's debt settlement is really second only to bankruptcy in terms of severity on a credit history. So if you don't pay a debt in full, it's going to have a significant impact on your credit history. If an account's reported as settled, it takes a long time to recover, and it does have a significant impact on your credit scores.
There's a second question.
Any other questions?
Yes. If you settle on a debt, whether in installments or lump sum to a credit card company, how does this impact your credit?
Yeah. And then, so that's if it's settled. It will be reported as settled for less than agreed or settled paid for less than agreed. And it's going to have a very serious impact on your credit scores. And it can take years to recover, depending on how significant that impact is and what your overall credit history looks like. And it's going to remain for 7 years from the original delinquency date of that debt. I take that back. Yeah, so 7 years from the original delinquency date. So 7 years from the date that account became late. And so it's again, it's secondary only to bankruptcy in terms of severity in most cases.
Another question came in. What is considered a good credit score?
Yeah, so a good credit score is the score that gets you the credit you need at the terms you want. So not a very good answer, but depending on the model it's being used. So it's important to look at the score that you get and see what the scale is and where it falls within risk. Generally today, a good credit score is about 700. You'll probably qualify, probably won't get the best rates. If scores above 750 on Vantage Score and FICO typically will qualify you for the best terms and rates. So that's a very good score. 800 and above is what they consider super prime. So you'll be able to qualify for just for the best rates in almost every instance. But 680 is considered like near prime. That's just slightly above subprime. If you fall below 680, it's going to be hard to qualify at all. So 700 is good. 750 is kind of where you can be pretty confident you're going to get the best terms and rates.
Thank you. So this concludes our webinar today. Thank you for attending, and I hope this session was helpful to you. As a reminder, we'll be sending you a follow-up email with today's presentation. Have a great day. Thank you.
Thank you, everyone.